Hi, this is Daniela Cambone, and welcome back to StansberryInvestor.com. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, and Overstock before it shot up over 1,000%. This power gauge comes from the legendary Mark Chaikin. And right now you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugetrial.com for your free look. Again, that's powergaugetrial.com for your free look. All right, let's get to our segment today.
Hi, this is Daniela Cambone, and welcome back to StansberryResearch.com. If you're wondering whether 2022 will be the year that U.S. equities runs out of steam, that the bull run ends, well, hopefully my guest today will shed some insights. Please welcome to the show for the first time ever, Lyn Alden. She is the founder of Lyn Alden Investment Strategy. Lyn, been a long time coming. I followed your career a long time, so welcome to my show here at Stansberry Research.
Thanks for having me. Happy to be here.
We have a lot of ground to cover today. Obviously, want to talk about U.S. equities, get your thoughts on that. I want to talk about Bitcoin, want to talk the Fed, inflation, and of course, gold. But let's start with the Fed here, because after more aggressive inflation fighting words from Fed Chair Jerome Powell, the market is now anticipating 5 rate hikes this year, up from 4. And I like a recent tweet of yours to that point where you say, look, the Fed can hike a 0.25%, 1.5%, but can they normalize to structurally real yields? You say no. Why?
Mainly because of how much debt's in the system. And so if we back up a second, basically the Fed has, kind of two competing forces right now. So on one hand, they're the furthest behind in inflation they've been since 1951. So CPI is, 7%, rates are at 0. And so they're very far behind the curve as measured that way. The other side of it is that most measures of economic growth, like so, for example, purchasing managers indices, forward quarterly GDP growth rate estimates, those things are rolling over. They're softening, and so they're not necessarily pointing to recession, but they're pointing to a deceleration of growth. And historically, the Fed is most able to tighten policy into periods of economic acceleration. So PMI is going higher rather than lower. In fact, part of what caused so much market turbulence back in late 2018 was that they had been hiking the rates during that rising PMI environment, and then as PMI started to roll over, they kept pushing it, and eventually, the market gave them pushback. And so they're in this kind of tough position where inflation says to hike and the economic growth rate says soften. And they're already, near as dovish as they get. And then the kind of the macro backdrop for this whole thing is that with federal debt to GDP well over 100% and private debt to GDP even larger, basically that if they were to normalize to structurally positive real yields, so several percentage points of real yields, the interest burden would be very massive on that debt. And so the last time we were in this position was back in the 1940s. That was the only other time the U.S. federal debt to GDP was this high. And you had a period of financial repression where they held rates low despite the fact that inflation ran hot because they had little other choice.
So do you think they're going to reverse course and that's the strategy they're going to do?
I think my base case is that we're going to have negative real yields for most of this decade. Now, there can be brief periods where you have, say, a deflationary event. You can have these cycles, but I think that's the baseline going forward. And again, like you pointed out, that doesn't mean they can't hike. I think they certainly can taper the balance sheet. I think they can get some hikes in, but I think it's going to be relatively shallow compared to how much inflation's in the system.
Okay, so that's interesting, Lyn, because a lot of experts I've been reading, insiders, call them whatever you want, say that if they can hike half a percentage point, that should be the magic number to tame inflation. Do you not agree then?
I think whether inflation is tamed is mostly outside of the Fed's hands. I think there's other variables. So a big drive of inflation was the fiscal stimulus. And so as that pulls back to some extent, right? So we're not getting more and more stimulus checks going out. We're getting kind of that fiscal pullback. That should contribute to some disinflationary pressures, maybe within this larger inflationary context. The other thing to watch is what happens with energy, fertilizer, these types of key commodity inputs. And so on that side, you have supply-driven inflation. There's not been a lot of investment in those areas, especially energy. CapEx has been very low. Oil discoveries have been very low. There's not a lot of resources going to even the energy infrastructure, so the pipelines and the transportation infrastructure. And so we have a lot of shortages in that area. And I think that's more structural throughout the decade. And so I think we're basically going to have these ebbs and flows. The Fed can reduce demand to some extent, right? So they can slow down economic growth, but then that has its other set of problems. And so I think their tools are somewhat limited, and it's more about watching the fiscal side and watching what happens with some of these supply issues and CapEx.
It just really seems that they're backed up into a corner now. To say they're in a pickle seems like an understatement. So, how does this translate? What does this mean for U.S. equities, Lyn? What's your outlook for U.S. equities?
So because they are trying to tighten, and given that the PMIs and other economic indicators are decelerating, that's not a very good environment for equities, all else being equal. And I avoid giving specific year-end price targets for, say, the S&P 500. If you look at, say, Wall Street, there's almost no correlation between price target estimates and the actual outcomes. Instead, I just give a general outlook of whether or not the conditions look very favorable or not. And so over the past 2 years, we've had very strong, almost straight up in terms of large cap equities. But my outlook since December recently has been that 2022 looks like a much choppier year. And that could be maybe it chops sideways, maybe it goes down, maybe it goes up at a slower pace. So I don't have a specific view other than that I think it's going to be a less attractive environment for equities than last year and the prior year were.
So, for investors watching at home, what is one to do, given your forecast? If it is choppy, is it best to wait on the sidelines? Is it a wait and see environment? What do you do?
So I rarely make, kind of sweeping portfolio decisions. There's all sorts of tax implications with that. But I overall view that this is an environment for defensiveness. And so that can include having hedges, that can include raising cash, and that can include being diversified into other assets. So for example, I still think that there are reasonable choices within the value sector. I think precious metals are attractive. Bitcoin had a large sell-off, and I think that's also probably going to have a choppy year, but it's more in value territory now. I think some emerging markets are reasonably attractive. And so I think if someone is diversified and rather defensive, they can avoid some of the more severe scenarios while still participating in some of the markets that are actually pretty cheap and that have some growth.
You've been very vocal on the topic of Bitcoin and gold, so let's go there. You mentioned precious metals as a hedge. So you like gold as a hedge right now?
I think it's a reasonable hedge. Basically, that would be a play on the Fed not being able to tighten as much as they're forecasting and that the market's pricing in. If that event starts to occur, you probably would expect a weaker dollar, stronger gold, maybe balance in some emerging markets. And so I do like some of those plays. You can consider kind of emerging markets to be the more volatile, growth-oriented way to play it. So, for example, I've been bullish on Brazilian equities. I think if you look around broad emerging markets, especially emerging market value, they're reasonably attractive. But of course, they have, there's a lot of risk. There's a lot of volatility. Gold is a somewhat less volatile choice, a more defensive choice. It generally does well in economic decelerating environments, especially if the Fed is forced to be less hawkish, even if they're still being hawkish. They're still tightening, but maybe less aggressively than the market priced in.
As tensions between Russia and Ukraine escalate, could this be a black swan event?
Oh, absolutely. I mean, gold tends to move on these crisis events. Over the longer run, it's really about what happens with the currency. But if you have, if this disrupts energy, it seems like it's going to disrupt fertilizer to some extent, to the extent that it causes inflationary pressures, especially stagflationary pressures, rather than that kind of, pro-inflationary kind of, bounce back type of scenario. If it's actually more of a stagflationary supply side issue, that can be quite good for gold. And so it's one of those kind of tail risk diversifiers in a portfolio.
Before we get to Bitcoin, just curious to get your thoughts on the US dollar. I was watching back an outlook of yours last year where you were quite bearish the US dollar. In fact, you said you've been bearish the US dollar since 2019. Have your views changed or the same?
So for the most part, no. I turned bearish in late 2019. We did get that we had obviously the spike around COVID. That was kind of that tail risk. And then we had a decline throughout 2020. And I started to get neutral towards the end of the year where I was still structurally bearish, but we had, been rather oversold. And because I tend to be somewhat contrarian, I was concerned with how much people jumped onto that side. And so I was temporarily neutral on the dollar. That rally extended a little bit longer than I would have thought. We got a little higher and longer than I would have thought. I'm still bearish here, but I'm watching price action to see if it starts to confirm it. And so some of the things to watch, I think, are capital flows. So a lot of people focus on rate differentials, but it's also about how attractive U.S. growth equities are for the rest of the world. So if the rest of the world decides to pull out of some of those large cap equities, that would be dollar negative. And a similar thing would happen in the early 2000s when a lot of capital pulled out of the NASDAQ bubble. That was dollar negative for the next few years. So I think that's my base case. But it is, you're comparing it to the euro, you're comparing it to a bunch of other weak currencies as well. So my broader view is that fiat currencies in general are going to devalue with negative real yields. But if you start to get that capital rotation, the dollar could have a pretty significant weak period.
Are you describing the case of a full-blown currency war?
Well, that's been something that's been in many ways ongoing for a while. So currencies have been doing competitive devaluations. But what I'm talking about here is mostly about capital flows. So right now, there's a lot of capital stuffed into U.S. markets. So Americans are historically underweight foreign markets compared to their average. They have more capital in U.S. equities than normal. Their highest household allocations ever to equities as a percentage of their assets. And then the foreign sector, like foreign pensions, foreign sovereign wealth funds, are also heavily allocated to American equities. And so we have one of the largest concentrations historically. And so basically our valuations are rather propped up. And if you have kind of a reopening scenario, post-Omicron scenario, you could get some rebound in some of these emerging markets. And so we see Chinese credit impulses turning back up. We see Brazil is running into at least less headwinds than they were last year. And so if capital rotates to some of these other markets or these other opportunities, then I do think that's a challenge for U.S. equity indices as well as the U.S. dollar.
Let's talk Bitcoin now, Lyn. You just concluded a MicroStrategy world event hosted by Michael Saylor. Jack Dorsey also took part in the event. And in it, you were basically still making the case overall for Bitcoin. You said that you don't think it will head south to 20,000. And you mentioned before that you'd be looking to add Bitcoin here.
I think it's a good accumulation zone, but with the caveat, one thing I emphasized in that discussion was that Bitcoin's major bull runs historically, there's only a sample size of about 4 of them, but they 2011, 2013, 2017, 2020, those occurred during rising PMI environments, so economic acceleration. And so generally the type of period we're in now has historically not been great for Bitcoin's price action. Now, eventually you could get a decoupling, but right now Bitcoin's classified due to its volatility as a risk asset by most pools of capital. And so I'm not particularly bullish, say, for the calendar year 2022. My base case would be, kind of choppy action. Right now I would describe this as being a kind of a value bear zone where I think it's good for dollar cost averaging, accumulation, developing plans to accumulate for corporations or other pools of capital. I wouldn't describe this as being at capitulation levels. So we certainly, if you get some sort of market turbulence, you could have a capitulation similar to March 2020 or similar to the fourth quarter of 2018, where, as we talked about, the Fed was trying to still tighten into a declining PMI environment. If you get a capitulation like that, I would consider that a buying opportunity. I don't know if we're going to get that or not. So we certainly could see a break below 30,000 in that kind of capitulation type of environment. But structurally, I think looking at multiple years, say a 3 to 5 year time period, I'm still structurally bullish on Bitcoin when I look around the ecosystem. I look around what's happening on the Lightning Network. I look around kind of every cycle, the infrastructure gets built to absorb new types of capital. So first it was peer-to-peer, and then it was the early exchanges that didn't, had trouble getting bank access, and then it was the more regulated exchanges, and then it was the more institutional grade custodians and larger pools of capital coming in. And I think that trend is still intact.
What would it take for you to change your mind and turn bearish on Bitcoin? What would you need to see that you could say, hey, I could really see a crash here?
In a declining PMI environment, we're certainly open for a crash. So I don't rule out a crash. Like I said, we could get a capitulation. So I'm not like pounding the table right now. It's more like I think that the structure's in place. I think what would make it particularly bearish, like, one of the outlier events that I think would give you, say, a multi-year bear market would probably be if the US and or Europe did something extreme, like, say, cut Bitcoin off the banking system, prevent any sort of fiat inflows to exchanges. Other countries do that quite often. So China's been doing that. That's been a large impact in 2021. Nigeria did that. Now, Nigerians still heavily invest in Bitcoin, especially peer-to-peer, but they did sever it from their financial system. And so, for example, Nigeria doing that doesn't really affect the price of Bitcoin overall. But of course, if United States or Europe were to do that, that would probably have multi-year implications. But that's kind of that tail risk scenario rather than a base case.
So Lyn, in the face of red hot inflation, what is the best asset to own right now?
So I think I have a diverse approach to mainly towards the commodity side. And so I think, if you look at what specifically does well in an inflationary environment, energy, for example, it's hard almost by definition. If you have inflation, you're getting inflation in energy and other key industrial commodities. And so I think that remains an attractive environment. Now, I think we've kind of come pretty far pretty fast, so I wouldn't be surprised to see periods of temporary softness. I think most indicators, especially with the economy decelerating to some extent, I think year-over-year CPI could start to peak potentially by the end of the quarter. Now, that if we get some sort of key energy shortage and we get a spike in energy prices, that could prevent that from happening. And so overall, I think my focus right now is kind of on defensive values, so things like energy transport infrastructure, MLPs, for example. I think their healthcare stocks are attractive. I think there's a variety of ways to get yield, and then having exposure to gold, Bitcoin, copper, energy producers gives you that upside if you get that more inflationary type of environment.
Do you see one having an advantage over the other, gold or Bitcoin, in an inflationary environment?
So I think that mostly depends on what economic growth is doing and then factors relating to them. So historically, in a risk-on environment, you'd expect Bitcoin to do better. In a risk-off, more stagflationary environment, gold would probably have the upper hand. And so I think that you can look at relative strength of either of them and have exposure to both. There are funds, for example, Incrementum has a fund that mixes both together and benefits from that rebalancing of that volatility. And for many people that aren't decided, I think that's a good way to do it. But of course, then there are some people that they exclusively prefer one or the other, and I think that's fine as long as they have high conviction on that asset.
Lyn, bring it home for us. You gave us a lot of good stuff to digest here, but overall, big picture, what should the folks be thinking about back at home?
I think about managing time frames, and so I think we're potentially entering a disinflationary cycle in the U.S. within the broader context of an inflationary decade. And so the supply side for commodities are still very inflationary. There's not much energy capex happening. And so I think those are structurally inflationary pressures. And given how high debt is, it's very hard for central banks to meaningfully raise rates, to normalize levels, to positive real rate levels. And so I think cash is in a structural devaluation period. And so I think holding hard assets in general is the way to go for this decade, with the caveat being that having some cash for rebalancing optionality. And I do think that 2022 is a year we want to be somewhat defensive and not be, say, leveraged long some of these inflation commodity plays, and be open to the fact that I think 2022 could continue to be a rough and choppy year for a lot of different assets.
Okay, I'm happy you brought that up, the cash component. I was going to ask if that still makes sense for you as being part of a portfolio.
I've often joked that cash is actually the one speculative asset I own, because it's the one thing that I know is going to lose value, but that I still hold some anyway, due to the possibility that other things I actually want to own could go down and have a volatile period. Especially also if you run a business, if you have a household, obviously you need working capital. And so I wouldn't overweight that too heavily, but in the context of entering potentially a more volatile period, I think having a non-zero cash position and being able to rebalance into any stresses that happen can be useful.
Choppy waters ahead. Lyn Alden, I appreciate you coming on Stansberry Research. Thank you for your time.
Thanks for having me.
And thanks so much for watching. We'll have much more for you, so be sure to stay tuned. And don't forget to sign up for premier content you can't get anywhere else at danielacambone.com. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.